Hi, I'm Debra Brennan Tagg, President of Brennan Financial Services. Welcome to the market report for the third quarter of 2018, and thank you very much for joining us. The goal of the market report is to let you know what happened over the last quarter, give you some context so that you can understand it, and also to let you know the factors that we believe will influence the markets over the near term. Our themes this quarter are volatility, interest rates, and our evergreen theme, diversification. Let's get started. While we would all love to see 2017 all over again this year, those of us who've been investing for a long time know that that type of performance is simply not sustainable for long. Many of the investment market sectors worked well and in unison in 2017, but we know from living through many market cycles that a year like 2017 is not often repeated. Seldom do we see U.S. stocks and developed international stocks and bonds and emerging markets showing positive results, and all with low volatility. That was 2017, but that is not what we should expect in most years, and certainly not in 2018. One of the really interesting things that I see on this slide is the average quarterly return, the highest at 2.9% for emerging market stocks, and the lowest at 1.1% for both US and global bonds. The spread between those two numbers is just about what most investors would probably expect, with the higher risk assets, the emerging market stocks, providing a substantially higher average quarterly return. But my fascination is with the time frame with the worst quarter for each one of them. For stocks, across the board, it was 2008, just like we would expect. But for bonds, 2015 and 2016. That tells us a whole lot about the current state of the bond market versus the longer-term history of the bond market, and we'll dive into that a little bit later. Next, let's take a look at the world stock market performance for the second quarter, which starts to paint the picture of one of our themes, interest rates. While we have good news with the U.S. economy growing at 4.1% and the NASDAQ crossing 8,000 for the first time, as well as the U.S. consumer confidence hitting an 18-year high, we also see some issues that really shouldn't be ignored. The first is the deficit, which is currently projected to top $1 trillion starting next year. That level of deficit is simply not sustainable and will need to be addressed by the politicians, hopefully through lower government spending. That issue is a concern, but it's simply not what is driving current volatility. There is the issue with China and trade, which was one of our themes in our last market report. While I certainly expected the standoff with China to be resolved to a greater degree by now, we've instead seen a real doubling down of the strong trade policies against China, which could continue or could be resolved in the stroke of a tweet. This relationship with China, as well as the strong dollar that we've seen in 2018, haven't produced great results in international investments for U.S. investors. All of that brings us back to our interest rate theme. The Fed has raised rates 3 times this year and expects to do so again in the fourth quarter. They also expect to raise rates 3 times in 2019 and possibly even once more in 2020. Keep all of that in mind as we continue through the report. As we take a step back and a longer-term view of the world stock market performance for the last 12 months, we see that the All-World Index has a pretty significant dip in the beginning of 2018. You may not even remember it at this point, but it happened here at home as well, and it's the beginning of our volatility theme. Interestingly, what followed the dip was a quick recovery, followed by choppy but uptrending market activity. U.S. stocks by themselves had a much better trend line than this, but I do want to focus on 2 headlines that will continue our interest rate theme. The first is the yield on the 10-year U.S. government bond hitting 3%. Now, while the Fed has been raising rates for 3 years, this was a moment that the market pushed the rates up. That marked a real change in sentiment in the bond market, and it's been struggling ever since. The other factor that dovetails with this is the inflation number, which hit a 6-year high in May. One of the Fed's mandates is to keep inflation in check. So the inflation indicator tells the market and retail investors like you and I that the Fed will in fact need to continue raising rates. And in turn, that tells us that this will continue to be a challenging time for bonds. While this chart is focused on the world stock market, it also sets up an understanding of bond performance that we'll talk about next. This chart always tells the story of the diversification theme so succinctly. While emerging markets were still leading the pack throughout the first quarter of this year, they've been hovering at or near the bottom of the pack in the second and third quarters. There are lots of reasons for this, including the strong dollar and rising Fed interest rates, but the point is really that the emerging market index illustrates what long-term money managers know, and that is that last year's darling soon finds itself at the bottom of the heap. You can see here that the U.S. had a very strong third quarter, with returns from 1.6% on the Russell 2000 Value Index to a whopping 7.71% in just one quarter on the S&P 500 Index. What this chart does not show is the activity since the beginning of the fourth quarter, which we'll look at soon. I'll also highlight one more number here, and that is the 0.02% return of the U.S. Bond Ag Index. While we're pleased to see it's mildly positive, we expect that the returns of the bonds will broadly be lower than normal over the next year. While the performance of U.S. stocks in all time periods here is very impressive, some of this has reversed temporarily in October. Look at the extraordinary difference in return numbers this year between large cap value and large cap growth. What is really interesting is that this trend is true at the 10-year mark as well. So if you remember what we just talked about with emerging markets and how performance darlings seldom stay that way forever, this chart actually reveals a slightly different story. Large cap growth has really bucked that phenomenon for 10 solid years, driven at least partially by technology companies like Facebook, Apple, and Google. We do believe that these companies will continue to have massive value and to create ongoing change in our economy, so large cap growth may very well continue to lead for the near term. And even though this is a third quarter report, I would be remiss not to mention the October volatility in the market that had wiped out all of the year-to-date gains in the Dow and the S&P 500 as of the close of the market on October 24th. This is a reminder that up and down markets are both part of the experience of investing. We had already chosen volatility as a theme before this real volatility even settled in, so for us this was widely expected as we approach the midterms. The stock market has never liked uncertainty, and we currently have a healthy dose of uncertainty with the elections on the horizon. Depending on the results of the elections, we may see a bounce in the market, or we could see continued volatility until the stock market can make some assumptions about what the elections will really mean for corporate America. Now we'll take a quick pause to look at two charts to give us perspective on the current stock market activity. What you see in front of you is a 2-year history of the bond market and the stock market, represented by two different colors. In orange, we have the U.S. Aggregate Bond ETF, and then in blue, we have the S&P 500 ETF. So that shows pure index returns over this time period. What I want you to look at is right above where it says January 16th, and we see where the blue line dips below the orange line, which means that bonds were doing better at that point than stocks were. And then if you look for the rest of the chart, it looks like stocks have had a much better performance than bonds, and we would certainly agree with that. In fact, wildly better, 41.1% return as opposed to 2.55% return. But along the way, stock investors did have some hiccups that they had to make their way through. One happened earlier this year, right after January, so we saw a dip in the U.S. stock market, and the other one is the one that we're in right now, which you'll see at the far right side of the chart. All of this is completely normal, and we have to remember that if we are going to reap the rewards of the stock market, that we have to be ready for the volatility that comes with it. Speaking of volatility, this chart gives you an understanding of the VIX. Now, the VIX is a volatility indicator that is followed by market nerds like us. We love to watch it, and it is represented on the orange line here. Again, the blue is the S&P 500. The orange shows us the volatility against the S&P 500. And if you'll note the same 3 time periods, what happens is the stock market goes down and the VIX goes up. And this is very typical of the stock market. So going back to the beginning of 2016, which was the worst start to a year for the stock market ever, you can see that the volatility clicked up a little bit there. And we see it again at the beginning of this year. In fact, we had a huge spike at the beginning of this year. If you take a little step back and look at the middle of the chart from January 2017 to January 2018, the VIX, the orange line, was at a very, very low level, while the U.S. stock market had some really solid returns with hardly a hiccup at all. Now let's look at the right side of the chart again. In 2018, we see the big spike at the beginning of the year, and we see a spike again in October with the stock market falling off a little bit at the end. What I really want you to see here is that this is all really normal activity, and that what we saw in 2017, although it was delightful for all of us as investors, it was more unusual than today's current market activity. Now let's turn back to global markets. While last year was a strong year for international stocks, 2018 has not been as kind to U.S. investors who hold international investments. Year-to-date performance numbers are hovering on either side of zero, and the one-year numbers are mostly in the low single digits. If we just compare the large cap international returns to the large cap U.S. returns, the U.S. returns win by a large margin in all time periods that we can see here. In last quarter's market report, we talked about the cyclical pattern we've been in for over 10 years now, where the U.S. markets have outperformed the international developed markets. And while we still believe that international markets may have a better future outlook than U.S. markets, the current tariff and trade policies that have been put in place this year, as well as the surge in the dollar, have really dampened returns for investors. Speaking of dampened returns, emerging market stocks have been caught in a perfect storm in 2018. After their high-flying performance of 2017 and even into the beginning of this year, they've had a real setback over the last 2 quarters due to rising Fed rates, trade policy changes, and the strong dollar. We do believe in the long-term potential of emerging markets, but investors really have to be able to withstand the ups and downs in this segment of the market, which is why they only represent a small allocation for us, even in our growth-focused portfolios. Real estate investment trusts, or REITs, had a mixed quarter with U.S. REITs up and global REITs down. That's a great story for U.S. real estate, since a rising rate environment, which we are currently in, is usually a negative for any type of investment that produces income. That's been a major challenge for bonds, as we've talked about, and for dividend-producing stocks, which are 2 of the other big asset classes that produce income. We still favor investing in private real estate as opposed to public real estate, which is traded on the public markets. We use real estate to diversify our portfolios, so we appreciate that private offerings don't suffer from as much headline risk and also don't have as much day-to-day volatility as their public sisters. We'll take just a brief pause on the commodities data once again to confirm that even the long-term investors, for the most part, have not been properly rewarded here. The one-year numbers are positive, eking out just 2.59%, while all other time periods are negative. Texas is known for commodities, and some of our better-known commodities, including crude, cattle, and natural gas, all posted gains, while most commodities were once again in the red. These commodities performance numbers serve to remind us that not all investors are rewarded for the risks they take, and that returns are not guaranteed even over the long term. We've been talking about interest rates throughout the market report, and this chart really tells the story. If we ignore the corporate bonds for just a moment, we see paltry returns from many parts of the bond market over the quarter, the year, 3 years, and even 5 years. If you remember from the beginning of the report, we talked about the worst quarter for U.S. bonds, which occurred in the 4th quarter of 2016. The Fed has been raising interest rates for 3 years, and that time period has been increasingly challenging for bonds. The good news here is that the negative returns are only mildly negative, which we would expect since bonds are not a volatile asset. But the bad news is that we expect this picture to continue into 2019 if the Fed continues its current path to increase rates. Very recently, the Fed has started to drop some hints that it may not need to raise rates as expected into 2019, but we're not placing any bets on it. We have made our bond side of our portfolios as defensive as we can, and we anticipate low returns for the next 12 to 15 months. The other bit of good news is that CD and fixed annuity rates are going up as interest rates increase, so very conservative investors finally have some options to lock in an acceptable fixed rate. And now we arrive once again at our evergreen theme of diversification. The mountain chart on the right and the return numbers on the left tell the same story quarter after quarter. The 100% stock portfolio substantially outperforms the 100% bond portfolio in all time periods. However, and today's market is a good test, higher risk investors have to be able to stay invested even when the market wipes out a year's worth of gains in just a few weeks. With the expectation of higher return comes the expectation of higher volatility. To be able to stay invested, your portfolio should always match how much risk you can handle in the time frame that you need to use your money and how much return you need to achieve your life goals with the money that you have. We are a holistic practice with a focus on financial planning and investment management. We manage portfolios for our clients based on their risk and their time horizon so that they can stay invested in both up and down market cycles. If you would like more information about our practice or about how we manage money, please send us an email at teamdbt@brennanfinancialservices.com or join us on our website. Thank you very much for joining us today.